Billions, trillions, gone. That's what the headlines say every time the market tanks. But here's the thing nobody tells you. That money didn't go anywhere. So where did it actually go? Let's break it down.
To understand what really happens during a market crash, we first need to clear something up. When the news says trillions were wiped out, they're not talking about physical money disappearing from somewhere. There's no vault that got emptied. What actually changed is the price, specifically the price that people are willing to pay for stocks on that given day.
Let's use something more familiar. Imagine you own a home worth $500,000. One day, a realtor tells you the market has shifted and your home would now sell for $450,000. Did you lose $50,000 in cash? No, your house is still there. Nothing about it physically changed. What changed is simply what a buyer would be willing to pay for it today. Stocks work in exactly the same way.
This brings us to one of the most important ideas in investing, the difference between a paper loss and a real loss. If you own shares in a company and the price drops, but you haven't sold those shares, you haven't actually lost anything yet. It's called a paper loss because it only exists on paper. The moment you sell, however, that loss becomes real. It's permanent. And that's why panic selling during a crash is one of the most costly mistakes an investor can make.
So if some people are losing, who's on the other side? This is where it gets interesting. A market crash doesn't destroy money so much as it moves it. When a nervous investor sells their shares at a low price, someone else is buying those same shares at a significant discount. That buyer is often a large institution, a fund, or simply a patient individual investor who understood that a lower price can actually be an opportunity. One reason crashes can escalate so quickly has to do with borrowed money. Some investors buy stocks using loans. When prices fall, the lenders who provided those loans can issue what's called a margin call, essentially a requirement to either add more funds or sell some holdings immediately. This forces investors to sell, even if they don't want to. That extra selling pushes prices down further, which can trigger more margin calls, which leads to more selling. It's a cycle that can accelerate a crash very rapidly.
During all of this, the money leaving the stock market doesn't simply vanish. It tends to move into assets that feel more stable. Things like government bonds, gold, or basic cash savings accounts. Investors call these safe havens. It's less about money disappearing and more about money looking for a quieter place to wait out the uncertainty. So the next time you see a headline about trillions being wiped from the market, take a breath. Remember that what's changing is the price, not the underlying reality of what you own. The number in your portfolio on any given day is simply what someone would pay for your shares at that moment. It will go up, it will go down. What matters most is whether you stay calm enough to let time do its work. Because in investing, patience has historically been one of the most powerful tools available to anyone, beginners included.